Did you know that Warren Buffett, one of the most successful investors of all time, once made a bet that shocked the world of finance? He wagered $1 million that an S&P 500 index fund would outperform a collection of hedge funds over a decade, and won. But what if I told you that the Oracle of Omaha's magic touch extends far beyond just index funds? Well, in today's video, we're peeling back the layers of Buffett's investment strategy to reveal what he's been loading up on that most of us haven't even considered. From tech giants that have become household names to hidden gems in the financial sector, we'll explore how Buffett's choices reflected his unique blend of wisdom, patience, and an unerring eye for value. Without further ado, let's get into it. 1. J.P. Morgan Chase. In the high stakes of the banking world, J.P. Morgan Chase has emerged as a titan, much to the delight of its long-standing supporter, Warren Buffett. Buffett, the legendary investor behind Berkshire Hathaway, has long favored the giants of the banking world, notably avoiding the smaller regional banks in favor of behemoths like J.P. Morgan Chase with their trillions in assets. 2023 was a banner year for J.P. Morgan, as the bank not only defied the macroeconomic gloom forecasted by its CEO Jamie Dimon, but also soared to a total return exceeding 30%, further solidifying its position at the pinnacle of the financial industry. Without a doubt, J.P. Morgan Chase's journey through the financial landscape has been thrilling for its shareholders, marked by significant dividend growth punctuated with intense volatility. Before the financial crisis that shook the world in 2008, J.P. Morgan was the epitome of stability, regularly rewarding its investors with healthy dividends and periodic increases. Yet, as the crisis loomed, J.P. Morgan, alongside its industry peers, faced an unprecedented challenge, slashing its dividend payout by 87% to a mere $0.05 per share in a bid to navigate the turmoil. The end of the crisis, however, marked the beginning of a golden era for J.P. Morgan. Riding the bullish wave of the 2010s, the bank not only recovered but thrived, with annual dividends soon surpassing their pre-crisis levels. The journey from crisis to recovery is encapsulated by the remarkable increase of its quarterly payout to $1.05 per share, a testament to a 2,000% increase over 13 years. The growth narrative continued into September of last year, when J.P. Morgan announced a 5% increase in its quarterly dividends, underscoring its confidence and resilience. Looking ahead, J.P. Morgan might opt for a steady course, potentially maintaining its dividend at the current rate throughout 2024. Even without further increases, the anticipated total dividend of $4.20 per share for the year would surpass 2023's payout of $4.05 per share. This strategic move would ensure that J.P. Morgan keeps its remarkable streak of dividend growth alive, further cementing its status not just as a leader in the banking sector, but as a beacon of stability and growth for its investors. 2. Exxon Mobile. Diving into the oil-rich seas of Exxon Mobile, we find a titan of industry that's not just drilling for black gold, but also crafting a treasure trove for its investors. In the latest turn of events, Exxon Mobile reported its second highest earnings in a decade on February 2nd. But what's even more tantalizing is the prospect of continued growth, thanks to strategic moves and geopolitical shifts that have sent oil prices on a roller coaster ride. The year 2022 shone brightly for Exxon, thanks partially to the surge in oil prices following geopolitical upheavals. Yet 2023 offered a glimpse into a potentially different future where oil and gas prices simmered down a bit. ExxonMobil's acquisition of Pioneer Natural Resources set to close into the second quarter of this year, coupled with an ambitious $26.325 billion in capital and exploration expenditures last year, signals a bold charge towards expanding its global footprint. The roadmap for Exxon points towards 2025, dotted with significant milestones hitting at a company on the brink of an exciting growth phase. But what really sets Exxon Mobile apart as a must-have in your dividend stock portfolio? Let's talk cash flow, the lifeblood of any dividend-paying titan. Exxon's end-of-year cash flow from operating in 2023, bolstered by asset sales, amounted to a staggering $59.5 billion. After dedicating $23.4 billion to capital expenditures, Exxon was left with a free cash flow of $36.1 billion. This allowed it to lavish $32.4 billion on its shareholders through dividends and buybacks, closing the year with a $1.9 billion more in its coffers. This financial acrobatics showcases Exxon's adeptness at not just sustaining but flourishing, funding its ambitious growth while rewarding its investors handsomely. The company's strategic foresight extends to its cost savings measures. From 2019 to 2023, Exxon aimed to save $9 billion. It didn't just hit the target, it sailed past it, achieving $9.7 billion in structural cost savings. Such efficiency paves the way for enhanced returns and buffers Exxon against future economic downturns, providing that the oil giant is playing a long game grounded in operational excellence and financial prudence. As Warren Buffett once said, "When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever." The cherry on top of this lucrative cake is Exxon's dividend policy. In the third quarter, Exxon announced its 41st consecutive annual dividend increase, a testament to its commitment to shareholders' returns. Though the stock price has seen modest growth over the last decade, the dividend has surged by over 50%, pushing Exxon's yield to an attractive 3.7%. It's not just the dividends that catch the eye. Exxon's aggressive buyback program, which returned $17.4 billion to shareholders in 2023, underscores a strategic approach to capital return, enhancing shareholder value while maintaining a robust balance sheet. 3. Johnson & Johnson. Now, Warren Buffett isn't someone you'd typically find dabbling heavily into healthcare stocks. The high stakes of drug development, the eye-watering costs of research, and the intricate dance of science that drives the pharma world are usually a bit off-brand for his investment style. But get this, J&J managed to snag a spot in Buffett's portfolio. Why? Because they've been handing out dividends like candy on Halloween, and that's something Buffett can't resist. J&J's story took an interesting turn last year with the spin-off of Kenvue, saying goodbye to its consumer goods segment. What's left are two powerhouse divisions that are not just growing, they're practically sprinting compared to the leisurely jog of the old consumer health division. Let's talk numbers for a second. J&J's pharmaceutical division saw a 7.2% jump in revenue year over year, and that's after sidelining the dwindling COVID-19 vaccine sales. Remember when everyone was dodging doctor visits like they were dodging spoilers from the final of their favorite TV show? That hit J&J's medical device sales hard, but not anymore. Their medical technology revenue leapt by 12.4% year over year. Talk about a comeback. And when it comes to dividends, J&J has been upping their game, increasing their payout by 32.2% over the past 5 years. With consumer health brands out of the picture, we could see those dividends getting even juicier. For 2024, the folks at J&J's hint at a 7.3% bump in adjusted earnings per share. Not too shabby, right? Now, hold on to your hats because oncology might just be the golden ticket for J&J. They've got this blood cancer drug, Darzalex, that's on the brink of potentially expanding its reach to include newly diagnosed multiple myeloma patients. The result? A whopping 58% reduction in the risk of disease progression or death. And that's not all. Balversa, a beacon of hope for a specific group of bladder cancer patients, got the FDA's full approval. This drug is reducing the risk of death by 36% compared to standard chemotherapy. 4. Visa. Now, this is not just any company. It's one that's caught the eye of the investment guru Warren Buffett himself. Though Berkshire Hathaway's stake is on the smaller side, in the grand scheme of Buffett's investments, it's a clear nod of approval to a company that's been smashing expectations. Since its IPO in 2008, Visa has been on the tear, delivering a whopping 21.5% annual return to its investors. That's no small feat. What's the secret sauce? Visa sits on the throne as the largest payment network operator globally. This title didn't come easy. It's the result of over 6 decades of building an intricate web of merchant and customer relationships, cementing its place with unwavering trust from banking partners. As Visa's network sprawls even more comprehensively, it's like watching a snowball rolling downhill, getting bigger and faster. It reinvests, scales up, and keeps adding more to its fortress. Let's dive into some numbers that make even the stiffest collars do a double take. In 2022, Visa processed a jaw-dropping $14.1 trillion in transactions. To put that into perspective, its closest competitor, MasterCard, handled $8.2 trillion, while others like American Express and Discover are way back in the rearview mirror. But Visa isn't just sitting pretty on these laurels. It's looking ahead, seeing a horizon filled with an additional $185 trillion in transaction volume potential, thanks to its platforms like Visa Direct and Visa B2B Connect. With over 500 potential partners tapping into Visa Direct, including titans like Stripe, Fiserv, and Adyen, it's clear that Visa is not just participating in the payment ecosystem, but leading it. The proof, as they say, is in the pudding. Visa's profit margins have been nothing short of stellar, averaging 47% over the past decade. And with free cash flow exceeding $19 billion last year alone, Visa is in a prime position to keep the innovation engine running, reward its shareholders with dividends, and continue its share buyback spree. 5. Apple. When Warren Buffett started gobbling up Apple shares in early 2016, it sent ripples through the investment world. Why? Well, Buffett had famously steered clear of the tech sector, claiming it was outside his circle of competence. But then, Apple caught his eye, and it wasn't just a fleeting glance. Buffett saw in Apple what he looked for in all his investments: a stellar company available at a fair price. But with Apple, it went more profound than that. At a Berkshire shareholders meeting last year, he didn't just praise Apple. He put it on a pedestal, calling it a better business than any we own. Since Buffett took his first bite of Apple in 2016, he's watched the tech behemoth's market cap balloon by an eye-watering $2.2 trillion. That's not just growth. It's a testament to Apple's seismic impact on Berkshire Hathaway's fortune. Even after trimming 10 million shares from his Apple stash in the fourth quarter of 2023, Apple still commands nearly 43% of his whopping $364 billion portfolio. It's clear that Apple shines the brightest in the universe of Buffett's investments. Buffett's admiration for Apple isn't just about the numbers. It's about the essence of what Apple represents, a business model that's in a league of its own. Apple's knack for innovation and an almost fanatical customer loyalty place it miles ahead of anything else in Berkshire's diverse portfolio. And let's not overlook the cherry on top: Apple's aggressive share repurchase program. This savvy move has gradually increased Berkshire's slice of the apple pie from 5.4% to 5.8%, boosting the value of Buffett's investment without him having to spend another dime. Now, as we wrap up, what companies or sectors do you believe hold the same potential for enduring value as the ones Buffett has chosen? Is there a Buffett pick hiding in plain sight that you've got your eye on? Share your thoughts in the comments. Also, leave a like, subscribe, and don't forget to turn on the notification bell for more investing videos like this one.